Welcome everyone to Meridian's first podcast episode. We've been talking about doing these for a very long time now, and something always seemed to get in the way or get too busy. But with the recent market volatility, negativity, those sorts of things happening, we thought it was really important to put a time in the diary. We booked our first guest after seeing him speak on this topic at our conference recently in Sydney. So locked in the diary, but unfortunately, since that date, I'm now stuck at home unwell and have a positive COVID child in the household. So we've had to reset, and hopefully we can get this out to you all as well as it would have been if we were at the office. So not going to stop us. We've got with us today Jeff Mitchell. He's the Chief Investment Officer of Infocus Australia, Head of Alpha Fund Management, and runs our investment committee. So we're excited to have him here. We've been having a lot of conversations recently with clients about what's happening with their portfolios, what's happening in the market, what's happening with the wars and the inflation. And it's a very different scenario to what we've seen a lot in the last probably several decades with markets down and interest rates going up. So we thought it was a good time to get it straight from the horse's mouth and see what's happening around in the world, what the expectations are, what they're thinking about, and also probably more importantly, how you invest in a portfolio when that sort of market environment's here. So I'd like to introduce the horse so you can hear it straight from his mouth. Jeff, welcome.
Hi, Mark. Thank you very much.
And thanks for taking the time. I was going to say, since we talked and prepared for this last week, there's been quite a lot going on. Markets have had a bit of a surge. So how have you been over the last few days? What's been keeping you up at night?
Well, apart from the dog next door, which seems to be doing a real good job of it, probably feeling a little bit easier about things now after the last inflation print coming out of the US. And I think probably sleeping, apart from the dog next door, a little bit easier than I was maybe a month ago. But it still doesn't mean that I think we're out of the woods, but maybe we can actually start to see some light between the trees coming our way. I actually might just, and sort of to maybe give a bit more detail to those answers, I've got a bit of a pack here that I'll run through, but by all means, questions come up and I'll try and get through it without boring everybody to sleep or worse.
Oh,
so
I'm sure you won't. There's some interesting conversations we were having since that conference, so I think there'll be some great information here to share. And hopefully next time we'll even have a chance to go live and people can ask you those questions themselves. But yeah, happy for you to run through. And if there's anything I see that our clients have been asking, I'll jump in and pose you those questions as well.
Oh, thanks. And by all means. So hopefully you can see that that on the screen there now. That's one. And as I've got to do this, otherwise legal will have a piece of me. But there's a disclaimer. We'll take that as read. So just want to pick up a bit, mostly to cover off on what are the big things going on in the markets. And clearly I don't have to tell anyone that inflation is a big story right now. Interest rates, there's been a lot of changes in rates. What's happened with the stock market? So it's all been that response, and a bit of geopolitics, because geopolitical risk is a bit higher now than what it was 12 months ago. Then just have a bit of a market outlook and say, well, where to from here? And how do we actually get to a where to from here scenario? And, while I don't want to raise the R word, we have to be prepared that we might get not so much a recession, but certainly a slowing down in the economy, if not domestically, certainly globally. So hopefully we'll pick our way through that one.
That will cover off on most of our clients' concerns, I would think.
Thank you. So let's start with inflation. And the chart on the left there basically shows that the US, the rest of the G7, which is the largest 7 economies in the world, and Australia, and everybody's playing the same instrument there, rising inflation. Inflation has gone up for a number of reasons, and it started to go up as the world turned on post-COVID, and we had interest rates went to nothing. COVID started to back off. Government started to ease restrictions on the economy and people traveling and businesses and back to work. and the world turned on, and suddenly there was this big demand for goods and services as the world turned on again. But because of COVID, the logistics supply lines, i.e. ships running from China and trucks running from port to store, and that was still all closed down. So once the economy turned on and go, we want stuff, the problem is that the supply line of stuff wasn't able to deliver the stuff. And of course, when you've got restricted supply and increasing demand, what happens? The price goes up. And hence we started to get price inflation. And that really has taken off mainstream. Now, initially, the central banks thought it was transitory. Oh, it will be okay. We've got this pop of inflation. But hey, once the supply lines turn on again, prices will normalise, the supply side will come good, and inflation will fall back down. What happened there was that China really didn't turn on. China has this zero COVID policy, and it was locking down its ports. It was locking up production, and the world just couldn't get the stuff it needed. So what that started to do was feed into the prices of everything, including services. So inflation started to get going properly. And the other part of that was that, as I said to Mark earlier, that Putin's timing of the invasion of the Ukraine couldn't have actually happened at a worse time for inflation. And I'll explain a bit more how that feeds into things down the track. But I want to move to the right now on the table there, and that basically just shows headline inflation from the US month to month. So you've got this inflation bogeyman, so you can see that ramp up on the left-hand side there to it. It sort of hit the peak of about 9.1 in June of this year. But since then, the annual inflation rate has actually been rolling over and coming down. But as we all know, we've all been living the experience. Every time the Fed has met since that period, they've been putting, the US Fed, they've been putting interest rates up by 0.75% every time they get a look at it. And same with the RBA doing 50-point rises. So if inflation's rolling over, why are the central banks still pursuing inflation with interest rates? And I think that's the balancing act that we're dealing with. So one of the things, to Mark's question, what's keeping me up at night? What is keeping me up at night is it's good to see that the US economy in particular is actually still really strong. It's good to see that inflation is starting to roll over. It's not so good to see that the Federal Reserve and the RBA are still increasing interest rates, because the thing about inflation is it's not an absolute number, it's a rate of change. So if the price of petrol is $1 a litre, for example, and it goes to $1.50 a litre, that's inflation at sort of 50%, if you like.
Yeah.
But if it stays at $1.50, inflation is zero.
Yeah.
But the price of petrol is still $1.50. Well, if you're not getting an extra 50% in your pay packet, for example, just really rough numbers, then you are going to be worse off because you're still paying that additional price. So this is sort of the reason why central banks are still chasing inflation with interest rates, because inflation is still growing. It's not there. So its rate of growth is coming off, but it's still growing, which is why we're still having rate rises. So remember that inflation, it's a rate of change, not an absolute level.
So Jeff, just on that side of things, you talked about the supply chain issues causing a lot of this inflation, the war and those sorts of things. So how does pushing the interest rates up affect that? Like it's not like lettuce prices were ridiculous because people were out there with lots of spare cash buying lots of lettuces, and we're not buying more petrol than we were. So normally interest rates would go up to slow down that spending. What do you see as the reasoning behind it now?
So what basically happened was, and a good question, Mark, the central banks took the view that inflation was transitory because of the turn on of the economy after COVID. But what happened with that was that it turned out to be real. And it's sort of like driving a car with your hand on the handbrake.
Yeah.
To contain inflation, what you've got to do is actually slow consumption, because what you're trying to do is fix a supply-demand imbalance. So if you're driving along and you pull the handbrake on one click and nothing happens, you mightn't even notice it. 2 clicks, maybe still nothing happens. 3 clicks, nothing happens. And this is basically what the Federal Reserve's been doing, putting interest rates up by 0.75%. It's just been slowly pulling on the brakes. Well, it gets to a point where, you do pull on the brake handle and, the car starts to feel it and it starts to slow. And that's the whole impact of increasing interest rates, to essentially slow down consumption or slow down production and actually slow the economy down, so that the price pressures that are putting inflation up start to ease and inflation starts to fall back into that, what everybody sort of, that Goldilocks zone of 2 to 3%. So everybody wants to sort of feel that their wages are going up by in pace with inflation, and that seems to be the sweet spot that they all talk about. It's in that 2 to 3%. So when inflation's running at, I think, 7.7 in the US, and I think we're sort of similar numbers here, that's still too hot. So that's why the central banks are still pulling on the brakes, because again, it's a rate of change, and 7.7% per annum is a lot further forward than 2 to 3. So to get it back to 2 to 3, they've got to keep pulling on the brakes, which means we'll still see more interest rates, because they've got to get that rate of change back into 2 to 3. And I think that, and probably, to say, well, why has the RBA only doing 25-point rises and the US Federal Reserve is doing 75? Well, they've actually got wage pressure in the States that we don't seem to have here in Australia. And once you start to get wage inflation into the system, that's a really hard one to get out of the system. So because we actually haven't had it here, the RBA has been a bit easier on policy, whereas, wages growth in the US has really kicked. So the Fed's going harder at wages growth, therefore going harder at inflation, therefore increasing interest rates more.
So just on the interest rate chart you've got there, obviously the official cash rate doesn't sort of fit into most mums and dads, most clients' everyday lives. So maybe could you give us an indication there, because we can see them getting up to about that 3.8, just under 3.8% next year. How does that sort of flow into, I guess, term deposit banking rates for our retirees and mortgage rates for our homeowners?
Yeah, Mark. So at the moment, our official cash rate, if you like, and that's set by the Reserve Bank of Australia, and that's essentially what it will transact with our big four banks, because the big four banks each have a bank account with the Reserve Bank of Australia, and that's the interest rate the Reserve Bank of Australia will pay the big four banks. And by doing that, they essentially make it the proxy interest rate for cash right through the economy. So what the chart is actually saying is, when the market or the bond market looks into the future and they weigh in all these things we've been talking about now, and they form a view about where they think interest rates are going to go, and where interest rates are going to go, that starts to get factored into other interest rates, like our 10-year bond rate and our 5-year bond rate and our 2-year bond rate. They all start to reflect what is the cash rate plus a risk premium, and typically that's just duration paid for. Like a 3-year term deposit typically pays more than a 2, and a 5 pays more than a 3, because you're denied access to your capital, therefore you should get more compensation. So what this chart's essentially saying is, the market is looking at this and it's saying that Australian government or RBA policy rates, they think will top out about 3.7, 3.8% in sort of September next year. That's only the view at the current time. That's not a fact. That's just on what we know right now. This is what the market sort of thinks. So, but it's actually calling, and as you can see, the rates go up and then they plateau across the top, and it's saying, well, we think the RBA, if it's 285 now and they're doing 25 points a go, maybe they've got another 4 rate rises in them before they stop, and they're sort of looking at that probably to happen sort of August, September next year. Well, given that the RBA meets every month, maybe there's sort of 4 at the front end, and we're sort of done by March, April, May, and then it settles down. But at the moment, the market's saying we think interest rates, there's probably 4 more 25-point rises out of the RBA. Now, if the economy slows up quicker than we anticipate, then this whole chart will move to the left, i.e. we'll probably get 1 less rate rise and rates will settle lower. So what it looks like from here is that term deposit rates are probably going to rise a bit more. But yeah, maybe there's another 1% in it, or maybe it doesn't quite get that far, but that's essentially what the market's saying here.
And mortgage rates then? So would you suggest normally about 2% above the cash rate would be a general average for mortgage rates?
Yeah, that's sort of where it is. And the banks are not going to set mortgage rates at a place where they lose money. So yeah, it's certainly a 2% spread at least, I would say. And if we start to get default risk rising or things like that, then the banks will price increased defaults into the mortgage rate, and that spread will open a bit because they've got a risk book to manage as well.
So a good time to be shopping around for your mortgages as well.
Indeed.
Thank you.
So sort of talking about those big drivers, but at the end of the day, and I think everyone unfortunately lived through the first half of 2022 where bonds and shares all sold off. And one of the reasons we stayed reasonably fully invested in the share market was the share market is about pricing the future earnings of the companies that are listed there. And what this chart here is showing is where companies reported earnings relative to where they were expected to report earnings. So just in simple parlance, the light blue bar is, if I look at second quarter of 2022, which was a June quarter, 57% of, and this is US companies, 57% of companies reported earnings in line with expectation. 33% beat by more than 5%, and 11% missed by more than 5%. So when you sort of look at that chart and look at it over time, so I've put it in there, so it's third quarter of 21, 22, you can actually see that those yellow bars are those that missed, and that number's actually starting to build. So there's more and more companies starting to miss by more than 5%, which is not a good story in itself. But the bigger part of the story is that there's still a preponderance of companies like 45 being in line and 39 still beating by 5% for the June quarter. Now, we expect corporate earnings are probably going to back up a bit as interest rates impact and slow the economy. Corporate earnings are going to take a bit of a hit, but we're not expecting a capitulation, if you like, in corporate earnings, which means that if the earnings are there, there is some support for the market. And that's essentially why when you look at the portfolio, it's still got a fair chunk of, depending on your risk profile, but it still looks like a normal portfolio. It's not like a portfolio that's running for cover. Now, whilst there's some nuances in there, we do sort of manage some risks in there. It's essentially saying that while corporate earnings remain strong, and that data is telling me that they do, we'll continue to hold an appropriate level of equities, i.e. probably about a neutral weight to equities in the hope that we'll get that excess return coming through. But notwithstanding, we look at 2023 and think if there is going to be an economic risk, if there's going to be a recession, it's probably a 2023 event, not something that's going to happen sort of running out of time for this year, but it's more a then than now thing. And
just on that, I guess the expectations are probably lower at the moment given what's happening in the environment. So that might explain the higher level of people that outperformed expectations, but that's been priced in, I'm assuming. So is there some sort of pattern on the ones that are increasingly missing their expectations? Or is that a certain sector in the market or anything that you've noticed?
Yeah, so and it's really interesting, Mark, what's happening is as anyone who's been watching the market, it's been a really volatile place. And it's been really volatile because what's driving it is not really economic fundamentals. What's driving the market is the market constantly looking at the central banks going, what are you going to do with interest rates? and the central bank's constantly looking at the inflation data and going, have we done enough to get ahead of inflation? So you've got this feedback loop that's essentially starting with the inflation number, going then to the central banks because they're responding to the inflation, and then the market is responding to the central banks because the market's basically going, anything that pushes interest rates up is bad for markets. So therefore, when we've had high inflation numbers, the markets have sold off because, oh, the cost of capital's going up. That's bad for me. Investors take the view, oh, well, that's bad for stocks, therefore I'll sell out. So companies that have been hit hardest are those that have got more sensitivity to interest rates. And that's typically your technology stocks because they're such long duration assets. Their profits go into the future so far that, you know, it's sort of like a long bond as opposed to a short bond. So technology's been hit really hard by rising rates. And what we saw last week was on Thursday night, the inflation number in the US came in below expectations, about 7.7 versus 7.9, and on the important core inflation, 6.3 versus 6.5. And the market, you know, the NASDAQ, where all the growth stocks are, did 7% in a night because it took the pressure off the central banks to raise rates. So the market's been really jumpy around that whole scenario. So when interest rates look like they're going up, tech stocks get hit. When interest rates look like they're coming down, the tech stocks rally, and it's your more value stocks like, you know, grocers and banks and those sort of cyclicals that do well on the other side. So when interest rates are going up, they tend to do better, and when interest rates are coming off, they tend to do worse. So this is this big spring that's going on at the moment, which is driving the overall volatility in the market.
Thank you.
And the other one, I'll touch on this briefly, but what we've got there on the left is the wheat price in the last 12 months and the oil price, West Texas Intermediate crude, for the last 12 months. And those two big humps, they almost overlay one another. The first spike on both times is when Vladimir Putin went with live rounds into the Ukraine. As you can see, the world was really worried about that, and shipments of grain and the impact on energy prices really drove inflation at a time when inflation was rising. So this really fed into increasing inflation. But as you can see, basically since about June or sort of late May, early June, the prices have actually corrected significantly for both, which sort of says that everyone sort of factored the Ukraine war into their metrics, and it's apparent that it didn't go nuclear early. The Ukrainians weren't firing live rounds back into the Soviet Union, so they're not actually hitting domestic targets in Russia. They're basically fighting on their own home soil. So the market perception has de-risked from it, and it says it's sort of, I wouldn't say it's back to normal. Both are still elevated, but they're not at levels that they were. So the market's sort of communicating, well, I know that the Ukraine is a really bad situation, but it's sort of in the price now. It's sort of become a known quantity, if you like. So where to from here? So we take all this information, what markets are doing, inflation, etc., and we form what's called a base case, of what we think is most likely to happen. And at the moment, our base case says, well, the US continues to tighten interest rates, which they are, but perhaps not as much as we thought a month ago, which is sort of why we've had that shot in the market. The RBA has slowed the pace of interest rate hikes, as the last two we've had have been 25s after the 50s. And that's sort of in response to, we actually haven't had that pop in wages. And also the RBA is pretty concerned about weakness in housing prices, because house prices have a big role to play in consumption in the domestic economy. And to that, we're starting to think that potentially what's priced in to bond markets about what happens with interest rates might have be overcooked to a bit. Maybe rates don't go as far as we think at the moment, and inflation starts to fall a little bit earlier. This is what we think is going to happen. Sales and corporate revenues, they hold up. certainly in the near term. So the share market doesn't get hit by slowing growth, and the earnings hold up. Therefore, the market remains a reasonable place to be invested. The Ukraine war continues, and energy prices remain high. So whilst they've come off, they still remain at these sort of $80-90 a barrel type prices when they could have been otherwise at sort of 60 or so, which is going to keep a bit of upward pressure on inflation. And we think China, post the last Congress, will find a way of stepping back from COVID zero policy to essentially stimulate its own economy, which is languishing at the moment. No signs of it yet, but we think that's got to be part of China's playbook to get their economy turned on again, which of course will be good for Australia because they will have to draw in more resources.
So just on that slide, so the cross arrows mean that it's been priced into the market already.
Yeah.
The green up arrow, is that a strong positive?
Yeah, and if it's this is not what's priced into the market, and if what we expect to happens, it'll be positive for equities. That's what the green arrows mean.
We did see a bit of that with the inflation number out of the US on last week, so that's obviously sort of happened already.
Starting to.
Yeah. And I noticed you don't have like an Australian recession on your list there. Does that mean it's not priced in, or you just don't think it's likely for us to experience one here?
Oh, Mark, you're going after the hard target. At the moment, a recession in Australia is not part of our base case. And the caveat to that is the risk of recession has gone up. There's no doubt about it. But on balance of probabilities, we think it's less likely. So hence, it's not part of our base case. It's certainly part of our bear case, but it's not part of our base case. So, and like just the point you raised, that we had a good data point out of the US last week. That's possibly going to translate to a good data point here, which then shifts that probability more in favour of not having a recession. Hence, we still, and this is one of the big debate points, we actually have our investment team meeting every Monday, and we will spend, I think we spent half an hour on it on Monday, last night indeed, arguing whether we should put a recession into our base case, and we're still not there yet.
So this is your base case. So normally, from what I've seen, you have about probably a 60% or higher probability of that one. But obviously, at the moment, things are a bit more volatile and uncertain. So maybe, because I've seen this before, maybe explain to our people watching that you sort of plan for multiple different scenarios. This is your base one, and then you've got some probabilities of a more positive one and a more negative version. So did you want to sort of run us through what could go wrong and what could go well?
Let's go to that. Let's go to the what could go wrong first. Typically, and thanks for calling that out, as you notice, this is our bear case, or what could go wrong. And we've got a 40% probability on this one at the moment. And that basically just says this is more than normal. Typically, in a normal environment, your bear case probably, it's about 20% to bear, 20% to bull, and about 60% on your base case. And I wish we were living in those times. But at the moment, the risks to the downside are probably greater. So we think about inflation proves to be longer lasting, and central banks continue hiking. So what we had last week was a blip, and the next time the inflation prints, it prints back to 7.9, and we go, oh, hang on, that was a blip. So inflation's here. So that would be put more weight behind central banks continuing to increase interest rates, which was then going to slow the economy. So that'll be bad. If that was the case, then you'd expect that corporate revenues and sales are likely to slow, because with interest rates continuing to rise, people don't spend as much. Therefore, sales, production, everything tends to fall away, and the economy starts to slow. Interest rates keep rising and house prices weaken because we've got, there's so much mortgage weight out there, and a whole lot of it rolls over to new rates in about March, April, May next year. So people that were getting the really honeymoon rates are going to start paying 5s or something like that, which is going to then cause them to have less consumption. That'll slow the economy. I'm not sure about this. This is sort of a grey swan, but what we saw in the UK was that some bad economic management by the government could really introduce risk to the financial system. If that was to happen, we're sort of talking about here about a 2008-9 event, sort of not GFC style, but that sort of an event. It's got a really low probability, but it's not zero. China persists with its COVID zero policy, and just the economy doesn't turn on and it falls into a deeper recession, and that's bad for us because that's less exports of resources. The real grey swans, the Ukraine war escalates into a bigger conflict. I think the recent events and the turn has shown that it's probably not going to do that. It's just Putin is being weakened domestically, and what will he do to get himself out of this hole? And he's a bit of a loose cannon. So there is the potential that he does an X factor event, that he fires a nuke or does something like that changes the balance. Don't think it's going to happen. It's probably a really low probability, but with someone like Putin, you just don't know. A new and more deadly COVID strain develops. Well, I think everybody's seen the news bulletins probably in the last week about the fourth wave already starting to get underway now. It doesn't appear that it's any more sinister than the stuff we've seen before. But what if it came through and the mortality rate just went off the scale? It's not. We think it's highly unlikely, but it's not a no probability. And God forbid, I don't know any reason why China would try, after seeing what happened to Putin with the Ukraine, but what if they tried to reunify Taiwan, and what would that do to geopolitics? Again, really, really low percenters, but again, not 0 percenters either. So that's sort of when we look at what could go wrong in a case, the red arrows, it's not in the market, but if it did happen, it'd be really bad. The lighter yellow arrows are saying, well, yeah, look, it's sort of in the price a bit now, but if it played through a bit harder, it's going to drag the market down. And we think that the COVID zero policy, in the absence of any sort of announcement, we think that's probably in the market as much as it needs to be. So that's sort of the bear case we're looking at.
So, and I guess the probability there, because that seems pretty negative. So 40% chance of possibly one of those things happening. But as you saw, some of those are partly priced in. The COVID China policies already priced in. So it's not necessarily bad for portfolios or massively end of the world, end of your portfolio type things.
Yep. Yeah. So like I said, the bear case is not what we think will happen. The bear case just highlights the downside risks that we need to be aware of when we're allocating capital. And sometimes things in your bear case end up in your base case because they actually happen, and then you've got to factor it in and the market reacts. And sometimes, on the good side of things, you can get a bull case scenario, which is what if it goes better than we think? Now, we've only got a 10% weight against this, so you can sort of see the skew to the downside in our thinking. But what if the announcement we got out of the US last week is right, and the next time the data print comes down, it's down another 30 basis points, and central banks go, oh, actually, it looks like we've done enough. So all those interest rates you've got factored into your bond prices, well, you can take them out, which means equities would just, we saw a 7% pile in on the NASDAQ on Friday. Could happen again, and markets could turn and rally really hard.
Because I guess that's the point, isn't it? They don't need it to get back to 3 to stop putting rates up. They just need to see it come at with your brake example, you need to see the car slowing, because if you leave it slowing for long enough, it'll get back to the speed that you need it to. You don't have to slam the brakes on.
Exactly right. And that's the way you'd like to drive, isn't it? And the US is already in a recession, and the Fed changes its mind on rate policy to restore growth. Now, well, again, this is in our bull case. I don't think that's likely. I think the US is in a recession. They've had data that points to it. But I start to look at domestic consumption, consumer sentiment, and those numbers, while they're softer, are certainly still quite strong. So what that's pointing to is the Fed really does aggressively stops interest rate rising. So they could do it. don't think they're going to. I think the number one is more likely to play through. And the other one, the Russia-Ukraine war ends with some sort of peace deal, and oil prices, instead of being $80, $90 a barrel, go back to like 60, 70 bucks a barrel. Wheat prices, fall back into normal ranges, and that in turn takes further pressure off inflation as well. So that would be the other side of the bull case. But
I guess on that front, we've done some research and put out an article on post-war. There's a lot of rebuilding to do, and a lot of resources and services going to be needed to rebuild Ukraine. So
yes,
that could be quite bullish for especially European markets, I would have thought.
You would think so. I think that just the end of the war would be positive for European markets, and the Ukraine rebuild, it is going to be a massive event, and very certainly positive for the economy. And it's a common thing that we talk about the peace dividend, and certainly there'll be a peace dividend for the Ukraine, assuming we can get peace.
So, Jeff, one of the big things, I guess, is people hear this stuff on the news, they get all this data, or we talk to them about what's actually happening in the world. I guess when there's negativity around, people think, oh, I've got to sell everything and sit in cash because that's my only safe haven. Unfortunately, at the moment, with inflation the way it is, that's probably a guaranteed way to lose money. So from your point of view, obviously these scenarios impact your decision making. How do you position a portfolio? I always say to clients, when no matter what's happening in the world, something's probably making money. So there's, as you said before, the tech companies might be doing poorly because interest rates are up, but somebody else might be doing better. So it doesn't mean just because the economy is poor that there's not opportunities to either generate some sort of return. Might not be as good as usual, but there's reasons to be invested and carry on, apart from the fact we know things like Friday happen. Whereas if you're sitting on the sidelines and things jump 7%, you can miss a lot of that initial recovery. So can you just talk us through sort of how you then build a portfolio with lots of negative news out there?
So thanks, Mark. So when you're building when there's lots of negative news out there, if we know it, the market knows it. And if the market knows it, often it's in the price. So, this year, for example, we've had, and certainly in the last 6 months, the Australian market's largely flat. So it's weathered this interest rate storm because a lot of that news is already in the price. So you're constantly looking for the portfolio, and particularly when markets are volatile or markets are heading down, you're looking to diversify your risk and looking for, and exactly, Mark, that's been one of the big plays, goes, where are all the interest rate sensitive stocks? Well, it's big technology that's really got that interest rate sensitivity. So in an environment like this, you tend to own less of that. You don't own none of it, but you tend to upweight things that tend to do better in that sort of an environment. So things like, the banks have had, a reasonably good run. You look at climate change, global warming, electric cars, lithium stocks, miners of lithium have exploded, particularly out west. You're probably more exposed to that than we are here in the east. But you're looking at those sort of drivers and go, well, this is actually an opportunity that we should be invested in now. So having that diversification, and it's basically it's not like an on-off switch. It's more like a dial. So you dial the dial back a bit on the things that you think are going to be negatively impacted by the environment, notwithstanding that they're still good businesses, and you turn the dial up on those things where you actually see the opportunity and the mispricing, because you never know what tomorrow brings. So that's why, and like that data announcement last week, if you weren't in big tech, even underweight big tech, even the underweight positions all went up sort of circa 7%. So you can't afford to be out of it. And again, that feeds into how compelling the argument is. If I turn that around and say, hey, let's use cryptocurrency as an example right now. Now, everyone's been talking about crypto as an investment. Well, now, because the exchanges are private and they're all starting to fall like dominoes in a row, is there a role for crypto in a portfolio? Well, no, there's never been a role for crypto in a portfolio. weeded because you can't see the earnings. You've got no visibility on the integrity of the exchange. Doesn't mean that crypto won't be a thing in the future, but just right now, the risk reward is just not there for crypto. But for someone like a Google or an Amazon or an Alphabet, you go, well, they're tied to consumption. People consume their products. They are going to have sales, just not as much as they thought. So you're constantly playing with those dials, and then there's the dials between, do I have equity or do I have cash? You know, when the market's really coming off and you think, oh, actually, there's information that's bad that's not in the market. I want to own less of the market because I'm waiting for the market to reflect that. But if we're thinking about a recession for next year, then potentially the market will put that recession in 6 to 9 months ago. So did it put it all in? Well, that's the question we're trying to deal with now, but it's certainly quite a bit of it in there. So, sorry, that's probably not a real strong answer, but it's looking at, you know, what's already in the market, what's not in the market, and trying to get the best risk-adjusted outcome as opposed to the best absolute outcome.
And I guess that's where we talk about people selling low and buying high. Normally, they're reacting to the information that the market has already predicted was going to come along or expected. So you're seeing that come to fruition already. You don't have to resell into that sort of thing.
Yeah, and it's a good point you make, because I reference the investment committee we have every week, and we'll bring ideas and talk about. You know, I'll use one as the example, and that is big tech stocks. And so last night it was, hey, the inflation number out of the US came in lower than anticipated. That's probably going to take pressure off rates, therefore that's going to be good for tech. And then the other side of it is, hey, tech went up 7-8%. Some of them went up 12% Friday night. Is that move already in the price?
Too late, yeah.
Are we too late here? Do we do that? How much is left? Well, look, if it's right, then tech's probably going to run further. If it's wrong, it's probably going to hold its own for a bit until we get the next inflation print. So that's another an example of, yeah, it makes a whole lot of sense, but just remember the market puts this in so quickly, which is why you need to be in the market. Because if you're out of the market and the event that you expect to happen happens, the market just puts it back in the price so quickly that by the time you get there, you miss most of it.
Yeah. And hence Warren Buffett's quote there.
Yeah. So be fearful when others are greedy. And I think I probably, and sorry, to complete the quote, and be greedy when others are fearful. And what he's pointing to here is really sentiment. And everybody's felt nervous about this year. People have been worried about the Ukraine. People have been worried about inflation, interest rates, Chinese economy. People have been more fearful than they actually have been sort of more bullish or happy about things. But when we're all feeling fearful, that's already in the price. And this chart here shows, well, this is the fear-greed index, which measures the balance between people that are feeling positive and people that are feeling negative. And it's sort of been in an extreme fear zone for a whole lot of reasons. But then the bars onto the right say, well, when everybody's feeling that way, what happens in the next 3 months, 6 months, 9 months? So you line up the arrow to sort of about -2, 3, saying, well, in the next 3 months, the market typically goes up about 18%. In the next 6 months, it sort of does about 15. In the next 9 months, it does sort of 22, 23 on average. And for the next 12 months, it's sort of 20%. So when everybody's feeling fearful, all the bad news is in the price. So if all the bad news is in the price, what direction can the price go? Well, typically it goes up. Whereas when the needle points around to extreme greed, you sort of move to the other end of the table and sort of what happens for the next 3 months? Well, not much. But for 6 months, 9 months, and 12 months, that next period after an extreme greeding on the sentiment index, markets tend to be negative. So, what we're saying is this is where we are now. Well, we're not quite at extreme fear. The needle's gone a bit after last week, but for most of those readings, we're still looking at a positive outcome in the equity markets, simply because a lot of the bad news is already in the price. Now, if Putin drops a nuke tomorrow, all bets are off, because that's not in the price. If China attacked Taiwan tomorrow, all bets are off, because that's not in the price. These are sort of things you only can form the view on the information that you have available. So in that scenario, all other things being equal, typically that's the outcome. So when everybody's bearish, the market tends to be positive going forward.
And that's over a pretty long-term data point there, 1970 to 2006. So
yep.
Yeah, had a few good extreme fear periods during that point, I would think.
It would be, it doesn't have the GFC in there as a data set, but I think behaviourally, I don't think it matters. I think there's enough instances to show that the behavioural response of investors does this.
Yeah. We got Black Friday in there, so that's a good data point.
Yes, yeah, 21% in a day, I recall.
So is that anything else you've got there that you wanted to share, Jeff? It looked like the last slide, or
I think we're good, Mark. I think
excellent.
Yeah, that will be enough. If that barking dog might keep me awake, but if this doesn't put you to sleep, I'm just not trying.
No, I think there's been some really interesting points in there, and thanks for answering all the questions that I've been getting asked to pass on to you. So I appreciate your time. Hopefully we get to do this a bit more regularly, and we'll see some of these slides pan out over the next 12 months. But thank you for your time, and look forward to the next one.
You're most welcome. Good luck, everyone. Hope it goes well, and we'll see you again soon. Thank you.
Thanks.